Hello everyone. Today we will discuss about asset accounting, which is also called Capex accounting. So what is asset accounting? It is a branch of accounting that deals with managing companies' various assets with a useful life of more than 1 year that are used in business operations. So today we will take brief overview of below points that are type of assets, basic rules for capitalization, what we can capitalize, what not, sample journal entries for asset accounting, asset revaluation, sample journal entries for revaluation of asset, amortization of intangible asset, summary on depreciation method, and tax implications on asset accounting. So also I would like to point out documents we need to maintain for asset accounting that are fixed asset register, purchase invoices, depreciation working, revaluation working, support documents for changes in value means if we increase or decrease value of asset, so we need support documents for that. And next is asset reconciliation report means reconciliation between asset as per books and physically existed asset. So let's look at first point, that is type of assets. So you can see there are many type of assets, and I have mentioned it here with relevant accounting standard and IFRS. So first is current assets that are with useful life of less than 12 months and that can be converted into cash within few months. Next is fixed assets that are long-term tangible assets with useful life of more than 12 months. Next is tangible assets means that are visible and physically exist, that is called tangible asset. Next is intangible assets means that are not visible but still exist like goodwill, patent, trademark. Next is liquid assets means that can be converted to cash immediately like accounts, receivables and securities etc. That is called liquid assets. Next is fictitious asset means that are not real assets but that are expenses and losses incurred and capitalized. For example, here preliminary expense, or you can say there is huge research and development cost and company does not want to transfer it to P&L whole amount same year, so company will capitalize it and amortize it over the years means company will capitalize it, show it in the balance sheet on the asset side, and company will amortize it over the year means transfer the part of the amount of that expense every year. That is called amortization. So amortize it over the year. That is called fictitious asset. Next is financial assets means investment in shares, equity, derivatives, etc. That is called financial assets. Next is deferred tax assets means difference between Companies Act and Income Tax Act means tax as per Companies Act is more than tax as per Income Tax Act. That difference is called deferred tax asset. Next is contingent asset means that are not exist in the present but that may arise in the future. That asset may arise in the future means, for example, company has refund due of 10 lakh but there is some cases going on for that in the court, so company may win the case and company in future will receive the 10 lakh. So that is called contingent asset which not existing at present but there is possibility of arising it in the future. That is called contingent asset that are not shown in the balance sheet but that are disclosed in the notes. That is contingent assets. Next is biological assets means that kind of agricultural assets, living plants and animal etc. Next is operating assets which are actively used in business operations, that is called operating assets. Non-operating assets means that are not actively used in business operations like uh, asset is lying idle and not used in core business operations like land or maybe some other investment in the property. Next is capital asset means that are long term assets are generally called capital assets. So these are all type of assets I have mentioned here. So coming to the next important point, that is basic rules for capitalization. So to capitalize any asset there are some rules as per our Indian accounting standard. We will go one by one here. First is future economic benefit. So any asset that should be useful for multiple periods of time if we are buying that asset. For example, machinery should be useful for more than 1 year, and that should be helpful to generate revenue for more than 1 year to the business, like 5 years, 10 years, like that. Second one is cost directly attributable, means any cost or expense related to the machinery or asset that we can capitalize. For example, installation of machinery, transportation, freight charges, that expense is related to machinery, we can capitalize. Third one is useful life. Useful life should be more than 12 months. Means asset should be long term asset to capitalize. Fourth one is capitalized till ready for use, means any expense or cost that should be capitalized till machinery or asset it is ready for use, and after the installation or after asset is ready for use, any expense related to that asset we cannot capitalize. For example, if we are providing training before the installation of machinery, that training cost we can capitalize, but after the installation again we need to provide training to the new employee, that again training cost we cannot capitalize after the installation. Fifth one is borrowing cost. Borrowing cost means any loan if we are availing to buy any asset like land or building. So interest on that loan we can capitalize. Sixth one is no capitalization for revenue items, means any general expenses or day-to-day expenses that cannot be capitalized as per the rules. So these are basic rules for capitalization. So next is regarding expenses which we can capitalize and expenses which we cannot. So there can be many expenses, but I have tried to prepare some list here for example and have given some descriptions for understanding. So you can pause the video and read it yourself. I will be moving forward. So let's look at some sample journal entries here for asset accounting, or we can say capitalization of asset. So for example, we purchased one machinery for rupees 5 lakh. So basic cost is 5 lakh, freight charges is 20,000, installation cost is 30,000, GST at the rate 18% is 99,000, and total amount paid to vendor 6 lakh 49,000. So first is purchase entry. Here assuming GST credit is available, means as per ITC rules, somewhere credit is blocked, somewhere credit is available. So here assuming credit is available, so machinery account that will come under fixed asset account as we are capitalizing it. So machinery account debit 5,50,000. So 5,50,000 including freight charges and installation cost. Then input CGST debit 49,500. Input SGST debit 49,500 to vendor account credit 6,49,000. Next, assuming GST credit is not available. So for example, we are selling some exempt product. So if company is selling some exempt product, ITC is blocked. So in that case, total amount will be capitalized including GST, installation and freight charges. So total amount is 6,49,000. So machinery account debit 6,49,000 to vendor account credit 6,49,000. Next, payment entry, that is vendor account debit to bank account credit. Next, depreciation entry at the year end, assuming 10% depreciation 55,000. So depreciation account debit 55,000 to accumulated depreciation account credit 55,000. And then we need to transfer the depreciation to P&L. So profit and loss account debit 55,000 to depreciation account credit 55,000. Next, for example, we are selling the asset. In that case, we are selling the asset for rupees 3 lakh here. So original cost was 5 lakh 50,000 and accumulated depreciation here is, for example, 1 lakh 50,000. So in that case, you can say we have loss of 1 lakh here. So we received 3 lakh. So bank account debit 3 lakh, accumulated depreciation account debit 1 lakh 50,000, to loss on sale account debit 1 lakh rupees, and to machinery account credit 5,50,000, which was the original cost of asset. Next, for example, we are writing off the asset. So let's say some fire incident happened. So in that fire incident, total asset is damaged. So entire asset is damaged. So we have to write off the total amount of asset, total cost of asset. So in that case, for example, accumulated depreciation is 1,50,000. So remaining amount 4 lakh we need to write off. So the entry will be accumulated depreciation account debit 1,50,000, loss on asset write off account debit 4 lakh to asset account credit 5,50,000. That was the original cost of asset. So this is due to damage asset. So moving forward to the next point, that is asset revaluation. Asset revaluation means process of adjusting the book value of the fixed asset to reflect its current fair market value. Means there is significant change in market conditions or cost inflations or asset conditions, means damage to asset or something. The value of the asset will change in the market, and to align with the change in the market value, we will increase or decrease value of the asset in our books. So that change in the value of the asset in our books, that is called asset revaluation. So why it is done? Mainly to reflect true and fair market value. To account for appreciation, means if we are increasing the value of the asset due to market conditions, that is appreciation. Or impairment means if we are decreasing the value of the asset due to some damage or loss, that is impairment of the asset. Or maybe there is merger takeover or IPO is going on, because of that also revaluation is done. And next, better borrowing capacity means to borrow some funds, we will increase the value of the asset to show higher asset base and to put weight on our balance sheet. So our borrowing capacity will increase. So that is for better borrowing capacity. And accounting standard applicable here is India 16, IS 16 and IS 10. So next we look at some sample journal entries for revaluations. Means here first is change in fair market value of the asset here. So original cost of asset is 10 lakh, accumulated depreciation is 2 lakh, carrying value means our book value is 8 lakh, fair market value is 9 lakh 50,000. So here you can see fair market value is more than our book value, so there is revaluation gain of rupees 1 lakh 50,000. So we will increase the value of the asset in our books. So journal entry will be asset account debit 1 lakh 50,000 to revaluation reserve credit 1 lakh 50,000. So new value of the asset will be 9 lakh 50,000. Depreciation will be calculated in 9 lakh 50,000 only. Next, impairment due to damage of the asset. So decreasing the asset value due to damage to the asset. Or maybe for example say part of the machine is damaged due to some reason, we will decrease the value partly due to that damage. So here machine is recorded in the books at rupees 5 lakh, and after the damage recoverable amount of the asset is only 3 lakh 50,000. So here impairment loss is 1 lakh 50,000. So impairment loss is kind of unplanned depreciation only. So every year we will depreciate our asset normally and decrease the value of the asset normally, that is planned depreciation. But impairment is kind of unplanned depreciation. So the journal entry here will be impairment loss account debit rupees 1 lakh 50,000 to accumulated depreciation account credit rupees 1 lakh 50,000. So this will reduce the carrying amount of the asset in the books. So again coming to the next point, that is amortization of intangible asset. So intangible assets are not depreciated, they are amortized. So what is amortization? Means part of the value of the assets every year will be transferred to P&L as per the calculation and as per the useful life of asset, that is called amortization, and value of the asset decreased every year. So to calculate amortization there is some formula, and most common one is straight line method, that is amortization expense per year is equal to cost of asset minus residual value divided by useful life. So we need to keep some points in mind here, like residual value is generally assumed zero unless otherwise it is estimated. And in case of useful life, intangible asset with finite life only can be amortized, means it should have limited useful life like 5 years, 10 years, then only it can be amortized. In case of intangible asset with indefinite life cannot be amortized, like goodwill or franchisee rights with unlimited rights cannot be amortized but tested annually every year for the impairment. So we need to consider first whether we can amortize the asset or not as per the finite or indefinite life of the asset. So we will take some example here. For example, we buy some software for rupees 5 lakh with useful life of 5 years and there is no residual value. So amortization per year is equal to 5 lakh minus 0 divided by 5 is equal to 1 lakh rupees per year amortization. So journal entry will be amortization expense account debit rupees 1 lakh to accumulated amortization account credit rupees 1 lakh. And while transferring to P&L account debit rupees 1 lakh to amortization expense account credit rupees 1 lakh. So this is amortization of intangible asset. Next is summary of depreciation I have mentioned here. So listed some depreciation method here. You can pause the video and go through it. So finally, tax implication on asset accounting. So generally in case of GST, we need to go through some ITC conditions and rules in detail to consider whether we can avail the ITC or not. So here I just try to mention some common rules here like GST on capital asset purchase. So for example, if we are selling some exempted product, in that case ITC is blocked while purchasing capital asset. Otherwise, generally, ITC is allowed in capital asset purchase. Next, GST included in asset cost. It means while capitalizing asset, if we are including GST, then ITC is blocked. But if we are capitalizing asset without GST, then ITC is allowed. Next, GST on sale of asset. So if we are availing or if we have availed ITC while purchasing the asset, then we should charge GST while selling the asset. Next, in depreciation, while calculating the depreciation, generally GST is excluded. But if we have capitalized the asset including GST, then depreciation will be calculated on the total amount and ITC will be blocked. So, next, finally, under section 17.5, so there are some rules and ITC is blocked on services and assets. So, there ITC will not be allowed. So, next, in TDS, finally, while purchasing the capital asset, if value is more than 50 lakh, then TDS at the rate 0.1% will be deducted. And in case of installation and other services related to asset, maybe TDS under section 194C or J will be applicable according to the rules. So finally, this is all about asset accounting and I tried to cover every aspect of asset accounting here. Hope you like my video. If you like, please press the like button and share the video. That will motivate me to share more and more knowledgeable video with you all. Thanks for watching.